we can go almost anywhere. So if you want to day trade, you can use this technique. And if you enter something for the purpose of exiting the same day, shortly thereafter, like within minutes, this will help you almost always make money. So, and when you don't, you'll lose very little if you stick to this like religiously. Okay, so you want to pull up the 20 period moving average. And I use that on daily charts. I use that on everything. The 20 period moving average is like Christ for me and for a lot of traders. Some things are like Christ for other traders, but whatever. Like the RSI, but this 20 period SMA. And you'll see that on all my instruction classes and stuff as always being this thick yellow line. That's just how I like it.
Did you say 20 or 23?
20, 0,
Okay.
20. Let me grab a drink, hang on. Ah, that's good. All right. So now, anytime the curve is flattening, it may be going into the opposite direction. We can assume that a little bit. So you can start this strategy at where it appears the momentum is slowing and the curve is flattening, like right around here. You can, it's not going down sharply anymore. It's right around here is where you could start this. And then as it goes up, so that moment there, somewhere around there, and all the way while the price is above the line, and the line is going up.
What line is that?
That's the 20 period simple moving average. As the price action is above it and the line is going up and the price action is above it, so not there, and it started to flatten out, it started to go the other way. So now you would want to be doing the other direction, puts or selling short. Here, that's the region where it qualifies for, in this case, calls or going long, what they call it, making money on it going up, buying the stock or getting calls. Okay, so I just want you to clearly see that that's the only regions that qualify at first. That's the first qualification that you have to go through. And that by here, that was over. So your opportunity zone in this first region of Etsy here was right around there, all the way to about there, where that curve started to go the other way. And now you would no longer take long or calls. Okay. Now, the next aspect of this is once it's under that region, and you can fudge it a tiny bit here and there. Okay, but once it's in that flattening and you know the potential is there and it's looking like it's like glaring you in the face, things are going up, and it looks like it's going to flatten and start to curve up. So you can kind of be confident in that. But you can even do this when the price action is way above this, if you didn't want to be so predicting, and instead just go with a confirmed uptrend. In that zone, you want to find a candle that is, in general, tiny. So that'd be this one. It's small. These ones have been long. Like, if you just statistically look at the candles, you can say like, this one is a small candle, 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 this one is a small candle. You can't teach computers to do this eventually with AI and stuff. We maybe could say that 10 years ago, but we are going to be really good at figuring this out. And like, I'm going to tell you in natural language that you're looking for the little candles like that. Okay. And the only way you can know that they're little is relatively. So you need to look at all the candles and go, is this a normal size or is this an atypically small candle? And it's atypically small. These ones are atypically small. If you just measure them by their body, that's called the body, not the wicks. if you measure them by their body. Okay? Now, so hopefully you guys are taking notes because there's several key components to this. So the first one was identifying that we're in a call zone or an up zone or a going long zone, a buying zone of stock. The second one is identifying in that zone a small candle, a relatively quite small candle, like not 50%, it might work, but you'll be much safer and more winning if you get it a little bit smaller. That doesn't mean you have to wait for every little teeny little one, because Evan said that, you know, if it's smaller, it's better. Once it's small, relatively, it's small. It's going to work. Okay, then qualification number 3 is that it needs to be the opposite color of the previous candle. No, that's not true. But what happens next needs to be the opposite color. So whatever this candle was, which it should be red, because if you're going to go up on a uptrend, essentially is what we're looking at, then you're going to be going up on a green candle, and it means the previous candle, or that little candle right there, needs to be a red one. So in an uptrend qualified zone, which was this here to here, you're looking for a little red candle. Okay, so that was like the third qualifier, little red candle, relatively. Then you let that candle happen. The next candle, if it breaks the high of that candle, if it had an excessive wick, then you would go by the body. But if it does not have an excessive wick, then you use the high. So there's some little finesse and nuances to this. But if this next candle goes above the high there, it's most definitely green. It's most definitely a green candle if it does that. At that moment, at that very moment, like boop, like where you can visually just barely see by the pixel that it went above it, hopefully on the last candle you've got it all prepared. If it's an option contract, you're going to want to buy at market, and you better be buying something extremely liquid, because if you buy at market, you might get the buy at the market, you might get the ask. Therefore, you hopefully don't have a big wide spread on that option contract. So you want to, I don't think this would work with Etsy on options. I'm not sure how liquid their options are. It certainly would work on SPY though. Okay, but you buy right there, okay, on when the candle, the next candle breaks the high of that little red candle. There's several reasons why that is. I'm going to go back at the end and show you why that's so awesome. Now, you're in, okay? You're in a trade, right? And you're crossing your fingers. But here's the thing. The next thing you want to think about is if the price goes below the bottom of that candle, the little red candle, if the price were to go down below the low of that little red candle, get all out. And that's the first thing you got to be totally disciplined about. Don't accidentally miss it and it goes lower and go, oh shit, maybe it'll come back up and I'll sell. No, if it goes below it and you missed it, sell it where you really fucking blew it, because you blew it. Sell it as soon and ever that it ever drops below that candle. You'll thank me later. You do not want to be developing the habit where you're like, hey, you know, maybe it'll come back, you know. No, you're going to get wiped out and this strategy will not work. So no matter where it is, because you weren't paying attention or you were, below this bottom of this red candle, get out if that happens. But it's not going to happen very often. And as you can see here, what goes on a beautiful run. Now, what you want to do is you want to sell. If you get options, you want to buy like at least 3 options contracts. And the reason is because you need like 3 at least profit targets so that you can ease out of this and be raising your stop loss. Because here's how this goes. So But if you buy stock, if you didn't buy options, stock is going to be fully liquid pretty much. So that could work too, but you're gonna have to do that on a cheaper stock probably. This is $100 stock. To buy 100 shares of it would be 11 grand. You can do it though, and if you do this as a discipline, you can make thousands of dollars a day. If you had that kind of money and you could day trade stocks at this level of like between $75 and $200 per share. So they're good stocks. Okay, so where was I? So. Number one, where to get out if it goes bad, and that's below that point there. Number two, where to start to take profits. And you want to take your first profit as soon as the price has gone about the distance of two of these little candles. And you can just eyeball it. You don't have to be like, oh God, I got, what's the high, what's the low, calculator. No, just eyeball it. It's about that big. So the first profit's going to be, by my eyes, it's somewhere right there. Right there. And when you do that, sell between 25% and 50% of your position. It takes a lot of the stress off. You are now profitable. You now just made a profit, and you still have some contracts or some stock shares going. And so in this case, the price continued. But what you want to do now is, this is, when it gets to the next zone, you're going to raise, not yet, but on the next zone. So that was the first profit target, was 2 distances of that little candle. But on the next profit target, 1 distance and another distance, so that'd be right here. You will sell another like half of the half, and you can keep halving your half if that works for you. So you might sell 50%, then the next time 25%, and then the next time 12.5%, and the next time 6%. And you can keep halving your half if you want, or you could do like thirds or quarters, or that kind of a thing, and keep it running. But once you sell there, now we're at 4 times the distance of the little candle. Now, if the price were ever to go down to where you got in at, there could be some slippage. So you want to look at your options contract price you got in at, or the stock price, and you want to set your price you would liquidate all your shares at, the remaining shares or remaining contracts, to that price in your mind. You're going to have to do this if you're a day trader. There's no time to set all these stop losses. But hopefully you're taking notes, because I'm going to give you a little bit extra detail right now. When to sell at your break even is when the bid has turned into your break even. Not the mid or the ask, but the bid. At that moment, be already ready. Already have your order set up and ready and confirmed, ready to send, get your hand on the trigger like a sniper, right? Ready to go, and just like right when the bid reaches your break even, just sell at market again. Do that sell at market, because you're going to get the market, you're going to get the bid, and it's going to be your price. You want to make sure you have no delay, or 1 second maximum delay on your system. Depending on your computer, no delay, so you can really not get much slippage there. So you'll make a little bit more money. It's going to make a difference. You'll make $5 to $15 more on a little bit of slippage that you might have got over a second, or $25. All right, but at this point, to where you've moved your stop from the bottom of the candle to your break even, you've already now taken out your second profit target. So break even, you move up to break even once you sold your second profit target. And then from there, you just keep repeating with your remaining amounts that are dwindling and dwindling. And you keep raising. The next time you go and sell at your next profit target, which will be another 2 lengths up, which is going to be, the second one was maybe right around there. The third one will be right around here. Now you're going to move your stop loss, your mental stop loss, up to the point in which you sold your first profit target. So you're always 2 behind. Does that make sense? You're always 2, like, increments of what you're doing behind. In other words, you took your first profit target and you never raised your stop loss off the bottom end of that candle. But when you took the second profit target, now you moved up to the break even. But in between was that first profit target level. But we don't do anything with that yet. But then when you hit your third profit target, now you move your break even up to that first profit target level. So there's always that space of 1 in between. And that helps you stay in the trade. It's 2 of those small candle wick distances in between. That's what's really happening. And you can eyeball it, it's gonna work out. As you can see in this trade, it works out, and we'll show like when it doesn't work out. And if you're continuing to raise that stop loss every time, you know, you're gonna get up here, you're not gonna get out here. It won't get out, you won't trigger your stop loss. That's another little candle, because these are consolidation candles. I'll go over the theory kind of after you get the whole full strategy. Then the price is going to go up here, and maybe it coincidentally happen to be, you know, 2 candle lengths, or maybe you can see weaknesses forming and you're sharp enough to get out at the top. But it's okay if you don't. It's okay if you don't. If it comes down and it stops out right about here, somewhere in here, guess what? From here to here is still all profit. So you're gonna like not be bummed out, and you're gonna be able to do this many times throughout the day. So that was the first trade. Boom, boom. And so I believe I covered every step that would keep you in the trade, and would also, when the trade goes against you, make sure you lose just very little. And it only goes against you about 1 out of 4 times, 1 out of 3 times, 1 out of 5 times. So about 4 out of 5 times, you're getting 1, 2, 3, 4, 5, 6, 7, 8 times the length of the candle. 4 out of 5 times. So 4 times 8 is 32. And then 1 out of 4 times, you're losing 1 length of the candle. So 1. So you're getting 32 to 1 return on your risk. You're getting 32 reward on your risk, but you're not holding till the end. You're taking profits. So it's going to come out closer to like maybe 10 or 15 to 1. But it's going to be very profitable. And then when this turns, well, let's see if there's another trade that happens. So you're looking for, on an uptrend, you're looking for a little red candle. So we're looking for a little red candle, and we're already out now. We're out of that other trade. We're looking for our next one. We're getting ready. Where's the next red little candle? And it's right there. So now you let that candle form. It's going to take a minute, and you're going to be hoping, because I do this all the time, you're going to be like, man, come on, make it small. No, don't do anything crazy. Stay right there. You know, I really want this to be the one. And then it forms, and you're like, yes. And then the next hope comes. Okay, please, no, don't go down there. It'll be red right now. It's going to be red. And you're like, no, give me a green. I need green over the top, and then boom, it happens, and you should have everything all ready to go. You know, your options or whatever it is that you're gonna go in, or stock, and you buy right at the instant, because it's all about being a sniper. And then it doesn't go below the bottom of this candle, so you're still in, and it goes up here, and when it's about 2 lengths above, so about right there, and about right there, you're going to sell your first profit target right there. And you still have your stop loss mentally at the bottom of this candle, and it goes more, and it goes another like 1, 2, and you're going to sell right there. And now you set your stop loss to break even. So you have to look back in your orders and check what price that I got filled at. And it's like, you know, something around here, you know, some region around here. It's going to be in your options contract. It's going to be a different price than the stock price, but you're following the stock chart when you're doing this. And so you want to like mentally go, okay, so $2.80 on my stock option, you know, but you know, it's at 113.46 over here. That's irrelevant. You know, your stop is the break even on the option that you have. All right. So anyway, we're up here, and you moved that break even. You moved the stop, mental stop loss, up to the break even where you would sell everything, break even. And then the price goes up about 1, comes back down, gets a little scary. and it goes back up. I think this would have triggered it right up here. And these should have been market orders. You would sell another remaining shares and you'd move your stop loss up now to your first profit target, which would have been boom, boom. Okay, right around there. And sure enough, the price falls down into it, and hopefully you're fast enough. You got 2 minutes. You got 1 minute or 2 minutes right there to where you sell all out. And again, that was at a profit. That was at a profit, even though it went down. You know, you don't really ever get just the top unless you just feel like it. And you're like, I'm just gonna sell all out now. This is a hell of a run, whatever. But you kind of shouldn't, because you should continue to keep some contracts going. This is why you want to get like 3 contracts minimum, because you want to get like a couple of these profit targets.
When you
yes,
scalp like this, do you still get a contract that has like 2 weeks left on the expiration, or do you do like end of week or end of next week?
At the money.
But I mean, like for the expiration date.
At the money nearest expiration when you day trade.
Even if it's like Thursday or Friday, would you still do the Friday expiration, or would you do the next Friday at that point?
Oh no, hell yeah, no, I do the closest.
Okay.
Yeah. And Friday, by the way, is the best day to the expiring Friday is the best day to day trade options, because they have so little extra rental time cost that you have to pay for, because it's almost dead at the end of the day.
Does the theta affect, like if I got a contract that expired tomorrow and was day trading with it, does the price move faster because the contract expires sooner versus like if I bought an expiration for next week, or does the theta not affect it at all in trading?
Relative to the capital that you're investing, yes. In other words, you'll be paying less, and so therefore it'll seem like the percentage return on your capital invested is much more than on previous days, and so it'll feel like you're getting better price, what you just said, acceleration or return, whatever you just said. But it's really just relative to that you're not paying so much anymore, because on Friday options are cheap. If somebody has a low account, small account, always wait till Friday to day trade options, because you're paying for 4 extra days if you day trade options on Monday. Unless you buy SPY, which has options that expire every day or every other day, then you can. If it's something else, you won't be paying. You'll be paying the cheapest you can for whatever the option is. Like if you were to buy at the money on Monday for something that's expiring Friday, it might be $450 for the contract at the money, whereas on Friday it might be $150. So it's a lot less.
But would the price move against you faster if the expiration date was closer rather than further? Or is it...
Not really. No, but it'll feel like it, because relatively, again, you're investing less, and then when the price moves away from you, you'll lose all your money sooner. But it's less money, because if you were paying $450 versus $150, they both go down to 0 at the same, but over here you still have $350 left, but over here it hits 0. See what I mean? So yeah, it's the same speed, but it's gonna feel like you lost all your money faster, or you made money quicker relative to that you just invested less. Okay.
But can you let the option, like if you're in profit, can you just let it expire at the end of the day, or should you sell it off? Like, I don't understand the assignment thing, but somebody mentioned that the other day. Like, is that something to be worried about?
Yes, a little bit. No, you don't have to be worried about it, but you should, or stressed about it. And I've talked about this in some other classes, but you should try and sell your contract back and stop trading options contracts like the last 25 minutes of the final hour. You shouldn't really be holding any. You should be done with what you're doing, because you could be stuck with a hot potato. I mean, who wants it? Like in the last 5 minutes, really, why would somebody pay $5 for that so it'll go to 10? I mean, who are these people?
On Webull though, you can't really. I've tried to buy options later in the day, and I don't think you can buy or sell like within an hour of close or something on Webull.
It depends on your brokerage, but some brokerages will auto liquidate any options that are close to making money, which is ridiculous when you think about it, because if they're close to making money, then let me have them. But If they're going to make money, that means they're in the money, and that means they're going to be assigned and all that, and exercise, etc. So they auto liquidate them 1 to 2 hours before closing. So be aware of that. So now let's say you wanted to trade puts on this downturn. That's what would happen. So when the curved down, you're now in a like put territory or selling short territory. And now you're looking for a small green candle, relatively small green candle. And so here we would be looking at that, and that's a borderline. I might get in on this next candle that breaks that low, but including the wicks, it's a bit big overall. Not the one I'm really looking for. And you can see the price doesn't quite crack yet, you know. So this one I love. There it is. That's the kind of candle you want to find. But the next candle was not red, which, you know, in this example, when we're going puts, the colors are opposite. So we're looking for a green candle. It's a consolidation candle is what that would be called. And then the next candle, we're hoping it'll be red and break the low. Instead of the other one was breaking the high, this one will break the low. And it did not, so we didn't get in there. We're looking for a little green one. This one kind of qualifies, but the next candle again was not red. And this one, not really. And then this one really strong down. So we didn't really get our trigger. I personally would take that trade there though, but I don't want to necessarily teach you that, but it's more advanced. I would take that because it just took out like two bodies of these candles. It's now the curve has been turning down right about there. The pressure is on. It feels like it could be the moment that it cracks. I'd be taking a little extra risk there, and my stop loss would have to be way up above here, so I could lose more. So I don't want to teach you that bad habit, but it can be good. You just have to like really know the market, really have a feel for this. That'd be like advanced level 2 or something. Just like don't do that, please. But then it cracks down, and we're looking for a relatively smaller candle. And relative to these bigger candles, this one does qualify just barely. It's on the small size compared to all these bigger red candles. I'd call it like 35% the size of the most recent typical big red candles. And so when that cracks that one, boom, you'd go short, you'd grab some puts, at least 3 again. Oh, cool, I didn't know if you clicked that. That's good. So now we're in the trade, and again, if it goes above this point, already be ready. When you enter this trade, don't be starting to get cocky and start to set up and get your trigger ready to take your first profit target. Instantly get ready to get the heck out of there with good discipline, just in case the price reverses and goes up above that point. That's the first thing you want to be concerned about with this strategy. So you get out above that point, but it didn't. It went up here and then it started to fall. It opened here, this candle. It went up and then it fell because of the way candlesticks form. I can know that. And it broke that low. You instantly got in, and now you're getting you ready to sell everything in case it goes above here. But then it looks like it's starting to head in your direction. You have a little bit of an uh-oh moment, but it's not too bad, and it continues to go in your direction. It looks like it's about getting to that 2-length point. So you switch over to selling just one of your contracts if you got 3, or 25 or 35% of your position if you were selling short, and you take a profit target right there. You sell one of your contracts, or 1/3 of your contracts, something like that, and then you still don't move that stop loss that you have above that candle. Your mental stop loss would be that candle, and yet it continues to go, and we're looking for another like 2 distances eyeballed. So about like right, it continues to go right here. Now you sell another contract, you sell short some more. And now you move to break even. So you again look in your order history and see what you got filled at, and start to get ready. You never know how fast these things can go. Boom, boom, boom. So get ready to possibly get out at that price if you start seeing it. And when you see it on the bid, you should have already your finger on the trigger and ready to go so that you can fire market, sell all shares, sell all contracts at market when the bid equals exactly your break even, the price that you paid for your shares. And you want to be fast about that. Just like the moment you see it, like milliseconds, 10 milliseconds later, just boom, just get rid of them. You'll have a little slippage. You might even get some price improvement. So it works both ways, but on average, you're going to get that price. So it's going to be pretty cool. But that didn't happen here. It kept going and it kept going. So now 1, 2, 1, 2, 1, 2. So now you took out another one here and you got to move your your stop loss to your first profit target level, which was like right around there. You can go back in your order history, see that you got that one filled if you forgot the price, and check, okay, that was that one, I was 2 back, 2 profit targets back, that's my break even. And then you keep going. First one was like right around there, next one's like right around there, next one's like right around there. It's going nowhere near on this, going back up, it's going nowhere near your stop loss, mental stop loss point. So you're still in the trade, and sure enough, it continues. And let's look at that. Look at that glorious run. I had it hidden by our people, by our Zoom video thing here, but I didn't even know this. But look at that glorious downward push. So now you're going to get another out right about there. Hopefully, you still have enough contracts and shares left that you would take that, and then you move your profit target to your stop loss to the second profit target you took. So now you can't even lose you can't lose money at this point. And then you get like another push down, and you move that profit target. I think we're probably right. I mean, the stop loss right around here. The profit target 2 or 3. I've already lost track. Maybe you're selling right around here, and I have to do the rough eyeball math. But you probably get out there, and then the stop loss profit target is moved somewhere around here, for which you're still remaining in the trade, and maybe you're starting to get an idea you should get out. So you do, and it hits your stop loss anyway if you didn't. But if it were me, I might start noticing that this is not really happening anymore because an uptrend kind of formed and the curve is starting to flatten. You can start to see momentum going the other way, and I would maybe get out another 5 cents earlier or whatever, but you would hit your stop loss and be out right there. So then again, you made a ton of money. So this is a pretty cool strategy for day trading, and the only times in which it's going to be really difficult, you're going to think that's easy when it does those nice long runs like that, but when it gets difficult and you might have those 1 out of 4s and 1 out of 5s is when it gets into this like choppy type of region. It's like it's going up, oh no, it's going down. It's going down as soon as it was going up, So you may actually, depending on how you get in here, which might be right here, you might actually hit a profit there, and you hit a profit there, and now it's set at break even. And you probably would break even out, and you wouldn't make much. You might make 5-10% on your capital, but hopefully you sell all your shares at that break even point at that point, because it's all about this system in order to preserve capital and make money and not lose money. So then it happens again and it goes under, and you're like, okay, I'm going to be ready to look for a little green candle and a red one that takes it out. And as it happens, that doesn't occur. So that's cool. You didn't get in a trade on a choppy moment there. And that's the way this system is designed. So you didn't waste any money there, or, have a whole bunch of hoopla for nothing, which it feels like when you get into one of these ones that just turns around kind of like right away on you and you get out. But it's important to get out. Just get out and wait for that next trade. They come up a couple times per day, and you just take each one, and you can make a couple thousand on the day depending on how much you're trading, or it might be a couple hundred. But we could do this all day. I mean, who here needs to see it again? If you would like me to, I'll do it again. I'll illustrate it again. But if you think you got it, then we got it. And let me zoom out a little bit so we could see how many more kind of like opportunities there were in that day. Like how much longer does this day go on? You know, you can see there probably is 1 or 2 opportunities per leg. We call these legs. There's probably 1 or 2 opportunities per leg, and they are all making good money when they make money, and they're losing very little money when they lose money. So long as you stay totally disciplined about that losing money side of things. You will lose more money if you mess up, and you don't want that. It's all about being like an athlete with this. I mean, like you want to be on top of your game when this is going on. And if you are, you're going to do good. So who thinks that's cool? Thumbs up.
Just a question, really. So, do we know if it's like going in like a terrain like that, like it's going up and it's going down, like can you easily just predict that's going to be positive, or is that just something rare that happens?
When the price goes above that previous candle that was small and it was the opposite color, and now when the price goes above that one, it owns 99% of the time, unless there was a gap up or something, very rare, it will be turning the color. It'll change to the right color. It'll be happening in the color that we just said. It'll be happening. You'll see it. It'll work. But I get what you mean. During the bar, for some of the time, it might be red, and it might flicker back and forth, and it might go green, and you get in, and it goes red, and then it goes down towards where you're supposed to get out, and you better be racing to get out, because if it breaks that low point of that little candle, you should get out. And that's how it works, and that's okay. Just be an athlete about it, man. Just like get it ready and get out. It's okay. You're going to be able to make some money on a big long one, another one. You have to take some of these ones where you get screwed and you need to get out like right away. They all aren't going to go correctly in that direction and make money for you every time. But when they do, they make so much more money than if you just got out at a little loss, the length of that candle. If you got out at that little loss, you're making so much more on the other ones. I mean, it sucks to lose money. It always does. But it's going to be such a little amount, and you're making such a big amount, that if you just keep doing that over and over and you don't mess up, you're going to be growing, mounds of money eventually. So I think I can see, like here's a reversal one. Do you see that, guys? And then this big green candle, and then I mean, this one probably went on for a long time and got out somewhere around there. And you're probably selling at multiple points. That's the important thing about this strategy, is it's forcing you to sell. So many of us don't sell. And we get in really bad habits of that, because we start with small accounts and we buy one contract. And you're either in or out if you get one contract. So you're screwed at the outset. So what does that mean? Raise hands. Sil, I've never seen that. Sil, do you have a question? My mic not working. Oh,
Yeah.
someone tell him I have a question, please. I do. Is that what you're trying to tell me? Is that Nathaniel has a question? Okay, where's the question from Nathaniel? I do. There's a lot of. Do I have to scroll way up? Nathaniel, your mic's not working. Where is Nathaniel? He's not even in here anymore. Oh, there he is. Okay. What's the question? I have a question, but regarding technical analysis, when you're ready, definitely profits. That's a great strategy. Where's the question? Where's the question? Where's the question? Evan, blah, blah, blah. I do have a question. I have a question. My mic's not working. Okay, so what's the question? It's not there. Hopefully he's typing it. All right, well, go ahead and type that, Nathaniel. I do see things there. So we'll get back to your question soon. Look up technical analysis. Okay, all right. All right, long thread. I have a question. I'm not seeing it. Would be quick for you to explain why Tesla is such a hot stock for traders. Look up technical analysis, set up moving average VWAP. I don't know if I'm seeing that. Technical analysis when you're ready. How do you spot weaknesses forming in this example?
I think it was a question where he said that do you have to have like multiple like monitors to be set up in order to have this?
In order to do this particular strategy or what?
Yeah, something like that, I believe.
No. Because look, I just did it with, well, I mean, you do want to have your order entry area, but I have a 4K screen, so I'm a little spoiled. I have three 4K screens, but you don't need much for this. As you can see, it's pretty incredible. You don't need much for this little day trading strategy. You just need that 20 period SMA and a chart, the minute chart. It actually works on 2-minute charts, 5-minute charts, depending on how you want to do it. You can get kind of like sometimes bigger moves. I like to do it on the 1-minute chart. You really got to be looking at it like an athlete, like I said. But then, maybe on the other window where I have like some other charts, those could be like your order entry panel. And if it's options, then you can have like the option order entry panel there. Or if you use Thinkorswim, which is this, what I use, you can, I'm going to pull up my order trader here, my day trader. So I can put SPY right there. And then over here, I can put SPY 20, what's the date today? 9. The next contract expiration will be the 25th. And let's say on the right, I'll put puts, and I'll pick the closest at the money one, like 325, 32, and I'm waiting for it to refresh. 325, hello. Okay, I think it's pulling it up.
Evan, I'm trying to put his questions up for you.
Yeah,
just
okay, thanks, but I'll
Yeah.
check it in a second.
Okay.
Let me finish this, and then I'll check it out. And then, so I'm putting SPY, the actual stock, whatever you're trading, in the middle. Okay, so I'm watching like the minutes on that. Then I'm putting the nearest strike on next to it in puts, and I'm grabbing and putting and I'm going to show you why. And I'm putting the SPY 200925 call. Let's say 325. It doesn't have to be the same strike, but okay. I'm putting my calls on the left. So I put my calls on the left and my puts on the right. And now I can turn on auto. I can put active trader on this thing down here. This is just how I have it set up. You could put it on the right, you could put it there, whatever, okay? It's just called active trader. And I put auto send on, and it's set to one contract. And this is for shares on the SPY. And then I have auto trader, it's set to active trader, set to auto send, and it's set to one contract right there. And when I'm ready to strike, all I do is hit buy market, boom. And I know when I'm trading SPY, when I do the strategy on SPY, I know I get a 1 cent spread on the options because it's so liquid. So it works really well, very little slippage on your price action over there. So I hit buy market, it's instant. It's like boom. I have, I don't know if you have Thinkorswim, but you can go into Thinkorswim and turn on direct routing, which means it will fill your order within milliseconds. You have to do that in the back end of TD Ameritrade. You can turn on direct routing, so you can have direct routing on your orders instead of brokered routing, which they try to find a better price, and it can take like 600 milliseconds, sometimes a second. So that's not good. So you want direct routing. You want a direct routing broker, which TDA is actually. Some people don't know that, but you have to go into TDA on the web and turn on direct routing. So anyway, you would just click buy market like at that instant, buy market at that instant, sell market, sell market. If you're doing this like a gamer, you can just like multi-click. You can be like, like if you want to get like 11 contracts, be like, it's and then when you're getting out, you could play it like a game almost. I'm not a gamer, but someone who likes to do gaming can do it like that. But I actually do it like that. But I'm not a gamer. But yet I play these stocks like games, I guess.